Welcome to Retirement GPS, navigated by Zynergy, your roadmap to a secure and confident retirement. Each week, we explore strategies, stories, and planning frameworks designed to help you navigate the complexities of life after work. From tax planning to investments, income strategies to risk management, our goal is to give you the clarity and confidence you need to make informed decisions. But retirement isn't just about the numbers. It's also about lifestyle, purpose, and peace of mind. We're here to guide you through both the financial details and the personal dimensions of this next chapter. Let's chart today's course.
Welcome back to episode 5 of the Retirement GPS podcast. I'm Zacharczyk, certified financial planner and founder of Zynergy Retirement Planning.
And I am Zane Belcak, associate planner here at Zynergy.
Today's conversation is one we've been looking forward to. It's the one we get the most questions about. We're tackling investments in retirement. We're not talking about hot stocks or market predictions. We are talking about how to invest with purpose, not just for performance. Once you stop working, your money has a new job. It has to pay you. That's a big shift, and the way you invest should shift as well.
And that's where a lot of people get caught off guard. They're used to saving and investing for growth, for time, but in retirement, the rules change.
Yeah, exactly. And you know what, the way I want to kick things off today is by telling you a story about a couple that we worked with, David and Elena. When we first met David, he had just retired from his 30-year career in pharmaceuticals. Elena had already stepped away from her job a few years prior, and they had a really nice nest egg at just under $2 million, $1.8 million saved, and were in a strong position financially. But emotionally, they were very uneasy about the next steps. See, they had come in after a particularly volatile month in the market, and they were used to always saving, always putting money away. Now their portfolio had taken a 12% hit, and they were really visibly shaken because now their portfolio had to pay them. Every time they needed to withdraw money, they felt like they were locking in a loss, which is understandable because that's the way it would have been in the 40 years that they were working. David looked at me in our initial meeting when we were sitting down and deciding if we were going to work together and said, we did everything we were supposed to do. We saved, we invested, and we followed the plan. So why is it so scary now? What are we doing wrong? And I definitely understood because I get this type of mentality a lot. Because what they didn't do yet was structure a portfolio that was set up for retirement. They were still investing like they were in their 40s. They were almost entirely stocks, very little cash, almost no bonds, and no plan for actually how they were going to draw off of their retirement. So yeah, every time they needed to take a distribution, which was monthly, they were selling at a loss. So we rebuilt it. We set aside 2 years worth of expenses in cash equivalents. Those are specifically things like treasury bills or short-term, very, very liquid safe investment classes, enough to weather any kind of short-term corrections. We created a midterm bucket for 7-ish years, which was a mix of different types of bond funds. And then we left the rest in long-term equity investments in place kind of the way they were, but we revamped them a little bit more towards our style. And that's money that really wouldn't be touched for, we'll call it 8 years or more, and would allow them to ride out any short-term market swings. But the change here wasn't the numbers, it was the mindset. We had to get them to understand that the volatility of their portfolio in the short term had almost no impact on their long-term lifestyle. And they did, because once we got all that in place and they knew where their distributions were coming from and how things were going to work, a few months later, it was like just bad timing, but the market dipped again. And this time it was even a bigger fall, down 18% from its high. But this time there was no call, there was no panic. In fact, they didn't call at all. They knew their income was protected. They had a system in place. They had a plan.
And that's really the shift that we're aiming for. Less worrying, more confidence, more stability.
And that's why we like to say that investment isn't about chasing returns. In fact, a lot of people get frustrated with us because we spend very little time focusing on returns. We talk about returns about once a year, but that's really all we need to talk about returns. We're not talking about returns monthly or quarterly because once we create a plan, and that's our job, is to create a plan that supports the way they want to live, then that plan will move into place and ensure that no matter what market environment we are investing in, no matter what market environment we're distributing in, and no matter what the headlines are saying, that you're going to be comfortable in your retirement. During your working years, when the market dips, it's just noise, right? Because you're not living off that money. You're still contributing. And in fact, the way I like to tell my young investors is that market volatility is your friend. We always want our young investors to understand, don't get wrapped up in the dollars in your retirement account, right? If I'm 30 years old and I have a 401k and it's $100,000 and it dips to $80,000, who cares? The dollars are irrelevant. What we want to get wrapped up in is we want to become an accumulator, an investor of shares. How many shares can I get? How many shares can I get ownership of, right? If I'm investing in an S&P 500 fund and the shares cost $100 and I'm investing $1,000, I get myself 10 shares. That's awesome. That's great. But if the S&P 500 falls to 50, right? Now my investments are cut in half. That may be frustrating, and that will be frustrating to most people, right? For me as a planner, I get excited because guess what? My $1,000 now gets me 20 shares. So I'm an accumulator of shares. I'm now getting 20 shares of the same exact thing. It's like a fire sale. So thus that market dip allows us to buy more shares when we're young and increase our quantity. And if I were your age, Zane, and I'm saving in retirement, I want that market to correct often, as many times. I always like to say I want it to go down and stay down, although that could create other problems in our economy, so maybe we don't want that. But market corrections are a golden opportunity to take advantage of accumulating shares. I like to say it's like Prime Day every day for my retirement, every time that market corrects. But when you're in retirement and you're drawing from the portfolio, it's different because now volatility is no longer your friend. So that's where that different mentality comes in. You have to change the mentality. Volatility actually can impact your lifestyle if it's not handled properly, because the opposite is also true. If I'm drawing every month from my portfolio and the market falls, I have to sell more shares to get the same dollar amounts. And now I'm quickly decumulating shares, distributing shares. We like to say decumulating, but it's not a common word. But we're distributing the cash, and we have to liquidate a lot more shares to get that cash. That's why we structure the portfolios based on that time horizon, and we call it time-based investing, and it's part of the core of our GPS framework. So we break the assets into 3 buckets. And this is not a new concept. It's not a concept we invented. You may have heard of this before, but it ties right into modern portfolio theory. The first one is short-term needs. So how much cash am I going to need to draw in the next 1 to 3 years? All right. That's the cash component that we like to keep in our investment portfolio. So we have our emergency reserve. We talked about that last episode. That's anywhere from 6 months to 12 months. Then we also have another year to 3 years. And again, that depends on a lot of things, sort of risk tolerance and size of the nest egg. But anywhere from another 1 to 3 years in cash type equivalents. Those are short-term bonds. Very, very low volatility. We're going to get a decent return on those things, but not a lot. We also know that when we're taking that monthly distribution, that money is there. It's not going to be volatile. And we don't have to worry about where our next meal is coming from. It allows us to sleep at night. Then we like to have our second bucket, which provides us anywhere from years 1 to 3 all the way up to 8 to 10. And that bucket's going to include things like immediate term bonds. And there are different types of bonds that we'll use in that bucket. And it's actually designed to be an offsetting investment to stocks, because when stocks go up, bonds tend to go down. And when stocks go down, bonds tend to go up. So we like to have that negative, we call it negative correlation, that seesaw effect, that when stocks are going down, bonds are going up. And then lastly, our third bucket is long-term growth. And that's the money that we're not going to touch for at least 8 years. We can ride through any sort of bear market, any sort of really bad market environment. Even during the Great Depression, the market only crashed for 3 years. Then it started to recover. The economy was pretty lousy for about 10, but the market itself started recovering after about 3 years. So that 8 to 10 year security blanket is more than enough to really cover any sort of really bad environment. And the stocks, even though they're going to have the ups and downs, we know we're not going to touch them for a long period of time. So we can kind of sit through that volatility and make money over time.
And I feel like that bucket strategy really works for any age, someone who's relatively young like me or someone who's older like David. It really gives every dollar a job to do. And when people see it that way, the anxiety starts to fade.
Yeah, exactly. And for younger people, certainly the bucket strategy is far less severe. We are far more weighted towards equities and long-term growth because we don't need the money. But when it comes to retirement, having that proper bucket strategy does take that anxiety away. Instead of thinking the market's down, I need to react. What am I going to do? How am I going to prevent the bleeding, right? For those of you who have been alive for more than 50 years, and most of the people listening to this podcast have been, you know that when the market falls, it ultimately recovers. As we are having this conversation on July 31st, 2025, the market is at all-time highs, right? What does that mean? The S&P 500 is at the highest it's ever been. The NASDAQ is at the highest it's ever been. The Dow is at the highest it's ever been. What that means is that every correction that has happened in the past has been temporary, right? It has to be because we're at the all-time highs. So if every correction is temporary, all we need is time to ride out those corrections. And that's the point I try to make to my people. People get so wrapped up in the headlines and the politics and tariffs and trade wars and actual wars and things that they see as the end of the world. They don't realize volatility is part of investing. And if we know that our short-term and mid-term needs are covered, then let the volatility do what it's going to do. Now, one piece that throws people off is the amount of cash that we recommend holding. In retirement accounts, we aim for anything from 4 to 12% in cash equivalents for people near or in retirement. And it may sound conservative. Some people will look at their portfolio and say, why do I have 12% in treasury bills? But there's a reason for it, because that cash gives us the flexibility. It allows us to avoid selling when markets are down. It gives us the time to wait for that recovery instead of reacting emotionally.
And I'll just say, when members see that kind of structure, it's really a relief. It turns something like investing into something intentional, not reactive. Now, since volatility is such a problem for retirees, why don't we keep all of our retirement funds in cash or safe investments like bonds?
Yeah, no, it's a great question. People come to us and they say, I just want to purchase an annuity. I just want all my money in bonds. I just want to have it in cash because now I'm retired and I need to be safe. People are afraid of market volatility. They effectively want to protect their money and keep their money out of harm's way. It is a massive risk in retirement. But unfortunately, there's also another risk in retirement that we need to manage, and it's a far more sneaky and deceptive risk for retirees, which can have an impact on their quality of life and their purchasing power over time, and that, of course, is inflation. So the loss of purchasing power is really dangerous to retirees. It's just as dangerous as market volatility, and these are two ends of the seesaw that we always have to manage, because if we're only focused on one, market volatility, then we're going to be subject to the other, which is loss of purchasing power or inflation eroding our living over time. So let's think about this a second. For what do you think the cost of a stamp was 20 years ago? Now, Zane, I know you probably don't remember what the cost of a stamp was 20 years ago, but I can tell you it was a lot less than it is today. A couple of cents, maybe a little more than a couple of cents. I don't even know what a stamp costs today. I think it's probably 70 cents or something along those lines. But I think about 20 years ago, it was about 25 cents. The cost to go to the movies. When I was a kid, and again, that was back in the Stone Age, but I was paying $7 for a movie ticket. And I just went with my son recently to see a movie, and we paid $18 each, and that was including a child's ticket. The costs have gone up, certainly. What about eggs? What about milk? What about your property taxes? You may say, well, I don't go to the movies, and I don't buy stamps. Well, fine. Property taxes 20 years ago, probably 50% or less of what you're paying for your property taxes today, especially if you live in the state of New Jersey. But I think we can all agree, no matter what sort of item that we pick out as a cost 20 years ago, costs were much lower 20 years ago and have gone up over time. And guess what? I'm going to shock you. They're going to go up over the next 20 years as well. And the problem is risk and return are always tied at the hip, right? The more volatility you accept, typically the better return you get over time. So our safe investments will reduce and eliminate market volatility, right? Our bonds, our cash, our T-bills, our emergency reserves. We're not going to see a lot of volatility in those investments, but we're also not going to see a lot of return. We're going to see anywhere in today's world, anywhere from 3 to 5% return in those types of investments, which is fine and will keep up with inflation. The problem is if I'm drawing 4% from my portfolio and I'm making 4% on my portfolio, my principal is not growing, right? I start with $1 million. It's earning 40,000 a year. I'm drawing 40,000 a year. Guess what happens in 20 years? I still have $1 million and I'm still drawing $40,000. What if my property taxes now all of a sudden have gone from $5,000 a year to $10,000 a year? How helpful is that $40,000? And I can tell you the answer because I've seen it happen. It is a problem. So this is why the other half of our portfolio or more has to be invested in equities, things like stocks. Yes, they're going to be more volatile. Yes, they're going to swing up and down in the short term, and they're going to drive us nuts. Every time a headline comes out about something the president says, or about some war, or about some thing that's happening overseas, we may see a market correction. However, the cash and bonds will ensure that we can eat well over the next few years, but the stock bucket is what's going to ensure that we can eat well in 10, 15, and 20 years.
That's a really important point, Ryan, and I agree. Most retirees, they seem far more afraid of market swings and headline risk than they do about that slow erosion of their purchasing power over time. I actually saw this happen recently with some of my grandparents' friends. They actually only had a pension and Social Security to live off of, but after 25 years of retirement, their pension, which was not inflation adjusted, wasn't enough to pay their basic bills. They actually had to move out of their home and ended up renting at the end of their lives. It was just a really sad thing to see.
Yeah, I've seen it too. And I see it far more often as a problem that gets almost no attention in the media or retirement articles. If you read something like Smart Money or Money Magazine, they're not going to talk about the slow erosion of purchasing power due to inflation. They're going to talk about market volatility and the killer of that. It truly is the silent killer that is just overlooked.
And another important concept to a properly managed retirement portfolio is rebalancing. Can we talk about that and why it's important to our listeners?
Sure. Yeah, absolutely. To understand rebalancing, first you need to understand the concept of portfolio drift. So the way we describe drift is we start with a portfolio, and we've talked about this already, where we have a certain percentage in, say, cash equivalent, certain percentage in bonds, certain percentage in stocks. But over time, certain things may grow faster than others. Lately, the stock components, the equity component, has grown a lot quicker than the bonds or the cash, right? And that typically will happen over time, but it doesn't always happen. In 2008, 2009, the bonds were destroying stocks because stocks were falling month after month after month, and bonds were gaining and gaining and gaining as interest rates were getting cut. But the whole point here is that allocations change. So if something starts out at 20% of our portfolio and now is 25 or 30% of our portfolio, it has drifted from where we wanted it to be, right? It has grown, which is a good thing. We want things to grow, but it's growing in a different proportion to the rest of the portfolio. It's growing much quicker than the rest of the portfolio. That's why we need you to rebalance that portfolio, because I'm going to give you an example. In history, in the 90s, large cap stocks, specifically technology stocks, very similar to today, had outperformed the entire rest of the market, every other asset class, because internet stocks were booming so much. And other stocks like General Electric and companies that weren't even tied to the internet were doing so well in the 90s that large cap stocks, particularly large cap growth stocks, had outperformed everything. If you had not rebalanced, sold some of those large cap stocks and rebalanced back into the other components of your portfolio, when the tech bubble burst came in 2000, you got significantly beat up in your portfolio because those stocks fell 85%, while the rest of the portfolio either gained or fell a lot less than 85%. So if you're letting that portion of your portfolio just grow and grow and grow, and we're not rebalancing, we need to bring things back in line so we're not subject to that massive correction that can really destroy our portfolio. So we do that through what we call rebalancing. And rebalancing regularly is really important. We don't do it to chase performance. In fact, it's the exact opposite of chasing performance. We want to make sure that everything is aligned with our original strategy. So by rebalancing, we're actually selling our winners and buying our losers in our portfolio, which, by the way, people hate. So whenever we do a rebalance, people are like, why are you doing that? You're selling what's doing well and buying what's doing poorly. That's what rebalancing is. If you remember Finance 101, for those of you who went through Finance 101, we're buying low and we're selling high. Most novices just rebalance annually. not a problem necessarily. It's not that rebalancing annually is any kind of a problem. In fact, we recommend it to our people that don't work with us in their 401ks or other accounts. Once a year, they usually do it in January, and that's fine. We tend to do it. We found studies have shown that rebalancing based on drift and not time is a much more effective way to rebalance the portfolio. When certain thresholds are breached, that's when it'll trigger a rebalance in our investing software. So in our case, a 20% drift in our retirement accounts and a 30% drift in our non-retirement accounts will trigger a rebalance, and then we'll just rebalance the entire portfolio back in alignment with the original plan. So we never drift too far from what we originally wanted, but we do like to see things go a little bit. Not to mention rebalancing in a taxable account will also trigger taxes, which is a totally different topic, but that's why we wait till it gets to 30% before we do that rebalance, just so we're not triggering taxes too often on a regular basis. For retirees who are taking income distributions to live, we can rebalance directly through those distributions. So if you're taking $5,000 a month from a $1.5 million portfolio and we have a component of that portfolio that's doing really well, that's what we're going to sell in order to create the cash to provide that income. We don't always want to sell our cash component or our bonds, even though that's what they're there for. If we're in the middle of a massive bull market run like we're doing now, like why not sell the S&P 500 when it's making all-time high after all-time high and keep that in line with where we want it to be? For most of our retirees, that's 25%. If it's up at 28, 30, 35% and we need cash, I'll tell you right now, I'm not selling something that is below proportion. I'm selling the S&P 500 because it's above proportion. Once again, allowing us to sell high, not low.
And I really like that strategy. It's really less based on headlines and more so based on drift.
Yeah, exactly. And speaking of headlines, let's talk about market volatility because it is one of the biggest fears that retirees have, and for good reason. It feels risky. And if it's done improperly, it is risky. But what most people don't realize is that the best days in the market often come right after the worst ones. So it is very common that when we have a period of volatility, and what I mean by that is not a couple of days, but usually when we have a few weeks or months of market correction, usually I start to see it when markets are down 15 or 20% is when people really start to get skittish. They call and they want to talk about what are we doing to revamp our strategy, to change our strategy. Should we be protecting ourselves? Should we be selling stocks? And the answer is nope, we're doing nothing. We are not revamping our strategy. We're not protecting ourselves, because if we weren't protected going into that correction, then I didn't do my job, right? We should have already had the cash, already had the bonds. In fact, if anything, we will be looking to do a rebalance, which means we want to maybe sell some of that cash and bonds and purchase some stocks while they're cheap, because most of the best days in the stock market come in the middle of bear markets. They come right after the market has fallen. So by selling stocks just simply because they're down means you're highly likely to miss some of those best days. We had a 10% market run in one day in April of 2025, just a few months ago, and it came after several horrible days in the market. So if we would have been scared because the president was putting tariffs on and nobody liked those tariffs, and the market was selling off and selling off and selling off, and we would have said, you know what, we can't take it anymore, we're going to sell our stocks, we would have missed a 10% up day. And by the way, the market didn't crash after that. That was the start of the next bull market. Now we're making all-time highs. So you can't say when things get better, I will get in. That is common misconception. And by the way, when things get better, you will be too late. When you are comfortable, you will be way too late. The market will probably already be at all-time highs. So that's why the structure that we're talking about matters so much, because you don't have to worry about that. You don't have to worry about the headline risk. You don't have to worry about the market volatility. You can put your head on the pillow at night, sleep well, because that cash and that bond component is there. If you've got short-term needs covered, you don't have to panic worrying about the money you're going to need 10 years from now.
And if you're still working, it's relatively the same idea. Volatility can really be your friend in this situation. Most of your money is in that long-term growth bucket, and it has time. You keep investing, you stay diversified, you stay the course.
Yep, exactly right. And we talked about that for our young people. Remember, collector of shares, not a collector of dollars. Dollars will come in time. We really just want the shares to provide the dollars later. So that's great. This is a great conversation. I'm glad we actually got to this topic because I know a lot of people have been really interested in it. But let's wrap it up with a few action steps. First, take a look at your portfolio. Are your assets organized by when you'll need them? And what I mean by that is if you're 30 years old and you're not going to need that money for 35 years, well, guess what? Being in equities, 100% equities, is not a bad strategy because we have the time and we can sit through the volatility. However, if we're 70 and we're drawing monthly, then 100% equities is a very bad idea. So based on other things that we talked about, how is your asset allocation based on your time horizon? Second, review your cash holdings. If you, again, or if you're in retirement, are you following the 4 to 12% cash rule? And I don't want to say it doesn't have to be cash itself, but it has to be short-term cash equivalents. 6-month treasuries, 3-month treasuries, these are great cash equivalents. And right now they're paying pretty nice interest rates. Third, check for drift. Has your portfolio drifted or grown out of proportion? Do you need to do a rebalance? If so, when are you going to do that rebalance? Because if it's grown too much, now's the time. And fourth, make sure you know where your retirement income is coming from each month. Whatever has drifted above percentage allocation is a candidate to liquidate for retirement income, right? We don't have to know every single month where our retirement income is coming from, but we do need to know what our rules are. And like I said, if the S&P 500 is supposed to be 25% of your portfolio and it's up at 30%, that is a great candidate for retirement income until it reaches 25% or under. If you're not sure of any of that, because it can get technical, it can get complicated, be sure to reach out to us. We have advisors that can help you with this kind of thing. It's what we do. It's retirement planning. That's what we are. Whether it's us or your current advisor, it's worth a conversation. Talk to them about how is your portfolio allocated and where is my retirement income coming from.
Thank you guys again for joining us today.
We'll be back next time with another GPS component to guide your path. We're going to be talking about retirement planning, which of course is close to our heart. So our retirement glide path, if you're within 5 years of retirement, this is going to be a really important topic for you. Be sure to subscribe to our podcast, turn on notifications, leave us 5-star review. If you don't like our podcast, don't leave us any review. Until then, stay disciplined, stay intentional, stay on course, keep planning.
Thank you for listening to Retirement GPS, navigated by Zenergy. To explore today's topic further, visit our blog mile markers at zenergyretirement.com/blog, where we offer detailed strategies, examples, and downloadable tools to support your retirement journey. Follow us on LinkedIn, Instagram, and Facebook at Zenergy Retirement Planning for weekly insights, checklists, and planning reminders. If you found this episode helpful, please subscribe, leave a 5-star review, and share it with someone planning for their future. Until next time, keep navigating toward a confident retirement. This podcast is for informational purposes only and is not intended as investment, legal, or tax advice. Listeners should consult their own financial, tax, and legal advisors before making any decisions. Zenergy Retirement Planning is a registered investment advisor located in Red Bank, New Jersey.